Good evening, TheoTRADE. This is Corey Rosenblum, and you're watching the Theo, not the video, for the 10th of October here in 2023. It's 10/10/2023. Let's get started. It is another update in the market with a rally bounce off of roughly 4,250 in the S&P futures. But I think the key is what I've been discussing, which is the Russell. And the Russell is in a sideways trading range. And I think the Russell still continues to show or highlight the broadness of the economy in the small sector cap or small market cap names. What does that mean? It means the economy, the broader picture, is neither really bullish, but it's also not really bearish. The truth is that the market, or at least the economy, is, the word I like to use, is muddling along. And it's just slogging forward, rallying, increasing GDP. And of course, we had the jobs, I'd say surprise jobs strength from last Friday, 300,000 some odd jobs at the headline to the top level number. So the economy is holding its own, but by no means is it a bull market, and it's just slogging or muddling through. That's what the Russell is doing, and to a little bit of an extent, that's also what the Dow Jones or the Dow mini futures are doing, slogging through. Most sectors have that same play. So the most recent trade setup, if we assume that this is a sideways trading range continuing, I have a lot of lines on the chart, but here's the main idea. We see support levels for the Russell future around the 1750, and each time we've hit that, the next move or swing of the market has been a little bit higher. That's going to be true within the IWM, which had a buy signal off the 170 for the ETF. And if we look at the Dow mini futures, or at least the Dow Jones, DIA, not something most of us trade, but nonetheless is worth a spot, 330 for the DIA. But we mostly pay attention to the S&P and the Nasdaq, especially traders here. The Nasdaq has shown relative strength, but that's on the large sense on the back of about 6 to 8 stocks. And these would include our popular Microsoft, Apple, Google, which we'll come to in a moment, Meta, Amazon, Tesla, maybe throw in some Nvidia, and some other stocks, AMD perhaps, or Netflix, which used to be popular, maybe Adobe. Nevertheless, the market cap weighting for the Nasdaq is concentrated in these stocks. Therefore, it is not the broader representation that the Russell, or perhaps even the Dow, and a little bit lesser extent the S&P do. So, mixed bag when it comes to the economic or the broad picture, and that is relating to a sideways trading range, not only in the equity market, but in a lot of our sectors. So let's take a quick mid-October update on our sectors. Financials right in the middle. And I'll be framing this as I do in my sessions in terms of distributions or bell curves. Meaning this, or the midpoint of the range, tends to be what I like to consider fair valuation. Not necessarily fundamental analysis fair valuation, which is crunching the numbers and the data and the statistics and the earnings and the like, but looking at fair valuation being the middle of a sideways trading range. That for the financials puts upper resistance at 36, lower support at about 31. Midpoint right there. That's fair value. For me, there's not really a trading opportunity when the market is priced or poised at fair value. Industrials are showing something similar with respect to a sideways trading range. Got a little bit overheated in the mid-portion of July-August of 2023, but has since pulled back to its fair value. And certain stocks like Caterpillar, big industrial name, is showing a reversal and a pullback inside of its trading range. So stocks in particular sectors, you can see what we might be looking for. So if you ever want to take a look at sectors, and I do recommend top down just means the market, individual sectors, and after the sectors, we'll look at individual stock positions to trade bullishly or bearishly, usually with in-out spreads or vertical spreads in the option market. Caterpillar, Union Pacific, Honeywell, GE, UPS, Boeing, Raytheon, which was in the news, and Deere are some of the names, Lockheed Martin and others, in the industrial sector, which is, roughly speaking, flat, unchanged for 2023. But so is the financial sector, actually a little bit down, but not by much. Financials are, roughly speaking, a little bit down, but unchanged for 2023. So are the materials. Materials sector stocks would include Linde, Air Products, Sherwin-Williams, Freeport-McMoRan, and others, Nucor, Corteva, and DuPont, just to name a few from a market cap or weighting standpoint in the ETF. What is this? This is your Analyze tab, and just taking a look at the ETF, you'll see which stocks lead or are the most weighted in there. And if we find opportunities in the individual sector ETF, we can certainly trade those, but we can also look to get a little more movement in individual equities or stock products. Not a lot to say about the XLB because it itself is in the middle of its trading range, as were the energy sector. The XLE had a short against this 93 not too long ago, with a downside target into 85, which was achieved with some volatility, but was nonetheless achieved into that target a little sooner than expected. But that is the reason I like to put stocks or ETFs in the context of trading ranges, because that does give opportunities to go short or be bearish from the top of the range back to the middle, or to be long or bullish from the bottom of the range back to the middle. Many of the ETFs and, of course, the market itself are showing those same sideways trading ranges, neither a bull nor a bear. That is a little different when it does come to consumer staples. And in our scans of stocks that are weak getting weaker, not so much today. Today was a strong up day in the market. We've continued to see these, we call it consumer facing, but consumer discretionary, and in this case, consumer staple stocks are making 52-week lows consistently, along with stocks in the utility sector. So we are getting the breakdowns in the consumer staples or the safety stocks. Think stocks such as food or drink or home goods, home supplies, cleaning supplies, and the like, even Campbell's soup. And on the other hand, we have healthcare stocks, which again are playing in its sideways trading range, and that range is a little wider for the XLV. That is support levels near 125, perhaps resistance 142, maybe we can even call that 136, which makes it not really tradable at the moment here at the start or middle of October. And the utility sector is getting a bounce after a continued week getting weaker, lows probing and lows holding until the break, when the market or the participants reduced their positions in the utility sector and key utility stocks such as NextEra Energy with a big down move, and they rotated into bonds or other products, including the safety of the US dollar index. So we're seeing a little bit of a reversal or a rotation in that. Speaking quickly about rotations, let's look at our performance on the intermarket perspective. What we're looking at is the S&P. Think of this as stocks. Underneath that is oil. Think of that just as the oil commodity. And commodities, I like to separate gold and others from the commodity sector. So this would be gold. GC is a future, so there's gold. And over here is the bond market. In this example, the 10-year Treasury note. And we have the ZN. We can easily use the ZB or the TLT. We can use ETFs, GLD, USO, and of course SPY. What's going on here? We had a sell swing or sell side reduction in positions in the stock market, in the gold market, and of course continuing to press lows in the bond market. Oil had a rally and then eventually did continue or at least press those lows, only to have the Middle East news send oil prices initially up about 5%. And the stock market has remained resilient, as has bonds and gold after this weekend's surprise geopolitical events. And the equity market has broken to the upside, along with oil, which again is separate. But let's look at how gold, the bond market, and the equity market all have rallied. And I think the word I'm using is resiliency in the plays. But finishing up the marketplace and finishing up the week ahead, we have some big economic headline news, which is going to continue what we looked at on the jobs report, which is a little stronger than expected. We're going to have the producer price index. That will take place on Wednesday. That's inflation data, key for what the Fed is watching and what we are watching here in TheoTRADE as well. Higher interest rates or higher inflation and stronger economic data does increase the odds that the Federal Reserve will raise those interest rates at their November meeting or beyond, and that is not generally a good sign for equity markets, or the bond market for that matter. After that, on Thursday, we'll have the consumer price index. That's your CPI. That's additional inflation data. These could be big market movers. And while we don't have economic reports on Friday, not major ones at least, we do have the start of earnings in financials and some other key stocks. But it will be financial earnings on Friday, inflation data on Wednesday and Thursday, and of course, a stronger, resilient market with a bounce off the support level lows, seen best, in my opinion, from the Russell. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for October 10th, 2023.